Every April, millions of Americans line up to file their taxes, dutifully contributing their share to the nation's coffers. But what if I told you that one of the world's most successful companies, Walmart, benefits disproportionately from the system, receiving billions in public subsidies and tax breaks, all while its workers struggle to make ends meet? This is the untold story of Walmart's financial practices and their hidden cost to taxpayers, workers, and communities. Walmart, the largest private employer in the United States, is a household name synonymous with convenience and low prices. For decades, it has symbolized the American dream of retail success, boasting a global presence and an iconic blue logo. But beyond the cheerful facade of rollback deals and everyday low prices lies a story that raises critical questions about corporate responsibility, taxation, and the role of public subsidies. Every year, while millions of Americans file their taxes, Walmart benefits in ways that often go unnoticed. Founded in 1962 by Sam Walton, Walmart has grown into a retail juggernaut. Walton's belief was simple but effective. Customers cared more about low prices than anything else. He reasoned that selling the same products as competitors but at lower prices would attract shoppers in droves. This strategy worked. By 1970, Walmart became a publicly traded company, and by the end of the decade, it had reached the billion-dollar sales mark, faster than any company before it. Over the decades, Walmart has become one of the largest and most influential corporations in the world. But while Walmart's business model has made it a favorite for many shoppers, it has also drawn significant criticism. The company's incredible success comes at a hidden cost to taxpayers and workers, fueling a controversial narrative that persists to this day. According to a report by Americans for Tax Fairness, Walmart and the Walton family collectively receive an estimated $7.8 billion annually in tax breaks and public subsidies. This staggering figure is enough to hire over 105,000 public school teachers. To put it in perspective, it's more than the combined budgets of many state education systems. The question is, where does this money come from, and why are taxpayers footing the bill for one of the world's wealthiest corporations? A significant portion of these subsidies, around $6.2 billion, arises from the low wages and minimal benefits Walmart provides to its 1.4 million U.S. employees. Many of these workers, despite being employed full-time, earn so little that they must rely on public assistance programs like food stamps, Medicaid, and housing subsidies. For instance, a typical Walmart associate earns an average hourly wage that falls below the living wage in many states. This means that while Walmart saves money on wages, taxpayers effectively make up the difference by funding the public safety net these workers depend on. For a single Walmart supercenter, the cost of public assistance for its employees ranges from $900,000 to $1.7 million annually. Multiply this across Walmart's thousands of locations, and the nationwide burden on taxpayers becomes clear. Ironically, Walmart also profits immensely from the very public assistance programs its employees rely on. With an 18% share of the food stamp market, the company generated an estimated $13.5 billion in revenue from SNAP benefits in a single year. This creates a cycle where public funds not only support Walmart employees, but also directly bolster the company's bottom line. But Walmart's subsidies don't end with public assistance programs. The company benefits from federal tax breaks amounting to roughly $1 billion annually. By exploiting strategies like accelerated depreciation, Walmart reduces its effective federal tax rate to just 29.1%, significantly lower than the statutory rate of 35%. Additionally, the Walton family enjoys over $600 million in annual tax savings, due to the preferential tax rate on dividends, a benefit that disproportionately favors the wealthiest Americans. At the state and local levels, Walmart reaps an additional $70 million annually through property tax abatements, infrastructure improvements, and other economic development subsidies. These incentives are often justified as job creation tools, but critics argue they represent another layer of taxpayer support for a corporation already swimming in profits. The Walton family also uses sophisticated estate planning strategies to avoid billions in estate taxes. By employing charitable lead annuity trusts, CLATs, they have transferred assets worth an estimated $7.5 to $9 billion, potentially avoiding over $3 billion in estate taxes. This maneuver ensures the family's immense wealth can be passed down through generations with minimal taxation, further concentrating economic power. These practices have far-reaching implications. For instance, redirecting the $7.8 billion in annual subsidies and tax breaks could significantly impact public services. In Texas alone, reallocating Walmart-related subsidies could fund nearly 12,000 public school teachers. In Arizona, it could pay for 2,500 additional educators. Across the country, this money could address critical needs in education, healthcare, and infrastructure. Critics argue that Walmart's reliance on public funds contradicts the company's immense profitability and the Walton family's extraordinary wealth. They question why taxpayers should subsidize a corporation that can afford to pay its workers a living wage and contribute its fair share in taxes. Proponents of tax fairness suggest that by closing loopholes and holding corporations accountable, the government could reduce the deficit and invest in essential services. Walmart's practices also highlight broader systemic issues within the U.S. tax and corporate landscape. The preferential treatment of investment income over wages, the use of offshore tax havens, and the power of corporate lobbying all contribute to a system where wealth and influence often outweigh fairness and equity. For its part, Walmart defends its practices by pointing to the jobs it creates and the savings it offers consumers. The company also emphasizes its philanthropic efforts, including investments in education, sustainability, and local communities. However, these contributions pale in comparison to the benefits it receives from taxpayers. Beyond its tax practices, Walmart has faced criticism for its impact on local economies. The so-called Walmart effect refers to the displacement of small businesses and the homogenization of retail landscapes when a Walmart store opens in a community. While Walmart creates jobs, it also puts countless local retailers out of business by undercutting their prices. This phenomenon has been documented in towns and cities across the country, leaving many communities with fewer options and reduced economic diversity. Walmart's labor practices have also come under fire. Despite being the largest private employer in the world, Walmart has faced numerous allegations of wage theft, poor working conditions, and anti-union tactics. The company has been accused of failing to pay employees for overtime work, denying workers adequate breaks, and retaliating against those who attempt to organize. Such practices contribute to high turnover rates and low employee morale, further exacerbating the challenges faced by Walmart workers. These issues are compounded by environmental concerns. As one of the largest companies in the world, Walmart's operations have a significant environmental impact. Critics point to the company's energy consumption, waste production, and reliance on global supply chains as contributors to pollution and climate change. While Walmart has made strides in sustainability initiatives, including commitments to renewable energy and waste reduction, many argue these efforts fall short given the scale of the company's operations. In conclusion, Walmart's story is a complex one. It is a tale of extraordinary success, but also one of dependence on public funds, systemic inequality, and corporate influence. As the company continues to shape the retail industry and the global economy, it raises essential questions about the true cost of its low prices. Should a corporation as successful as Walmart rely so heavily on taxpayer subsidies? And what does this say about the broader dynamics of wealth, power, and responsibility in modern America? While there are no easy answers, the conversation around Walmart's practices underscores the need for greater accountability and transparency in corporate America. By addressing these issues, we can move toward a more equitable system that works for everyone, not just the world's largest retailer.